For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Managing Your Financial Future. Hey, welcome back to the program. I always sound excited at the top of the show. I'm excited because I get to talk about things that I find interesting personally, and I think you folks find them interesting too. Otherwise, why are you listening to this podcast? The other reason I'm excited is I get to spend about, half hour or so with my buddy Professor Rick Plum, CFP, Certified Financial Planner Professional. I'm Johnny Dean, your podcast host. Hello, Rick.
Good morning, good afternoon, good evening.
Wherever you happen to be. And this is a topic that we're revisiting this topic from well over a year ago. And it has to do with, we're going to take this eventually in the context of a bucket one. But today's topic is back on the table because of the big change in interest rates that we've seen over the last year plus.
2 years, yeah.
Was it 20? Now, see, I'm losing track. When did they start rising? In early 22?
I believe so. Yeah, like
right?
Like you said, it's hard to remember
early,
that far back.
maybe the end of the first quarter of 22. We saw them rising, and they did so probably through early 23. And I think they sort of held steady for a while.
They've been up and down in almost a trading range, but they've been in that 4 to 5%, a little over 5% range for a little while now, but a little bit higher sometimes, a little bit lower sometimes.
Yeah.
Depending upon what news just came out.
Short-term stuff really doesn't matter. What matters to us is all the long-term, because none of this stuff that you're seeing now, the inflation data, that data, means absolutely nothing. You're going to totally forget about it in about a week, if not less.
Now, long-term, this is where semantics matter. What are we defining as long-term? Because when I look at long-term, I'm thinking stocks long-term, 15 years, 10, 15 years. But when I'm talking about bonds, I'm typically not thinking long-term as 15 years. I'm thinking long-term in the bond world. Now, obviously, bonds go out a lot longer, but I don't usually play with the bonds on a 15-year or 20, 30-year time horizon.
Well,
because I think I can do better in the stock market in a 15, 20, 30-year time horizon than what I can earn in bonds.
Yeah, and that may play a role here. But what we're talking about has to do with fixed annuities. And I'm talking about CD-like fixed annuities.
The ones where the rate is locked in for a series of years, and the surrender period on a fixed annuity lasts no longer than the rate guarantee.
Yeah, so are fixed annuities perhaps a better alternative to bonds? Now, what we saw back a year and a half ago during 2022 was that both stocks and bonds took a hit. They took a big hit. They were down in 2022. So the traditional portfolio of bonds being the safety net when stocks aren't doing so well.
The yin to the yang.
Well, we lost both back
both went down
at that time. So people started questioning this whole 60-40, 70-30, 50-50 stock bond
balanced
model.
portfolio.
Exactly, which they probably should have been questioning anyway. Okay, so the question back then was, will this happen again? We can't predict that, but what I want to talk about here is, are fixed annuities now perhaps still a better alternative to bonds? But let's get started with talking about how both of these things work, Professor Plum. A lot of people understand that bonds mean you put some money away, maybe you get some back as a regular payment.
Well, technically, you're lending money to somebody with a bond. The bond is the IOU. You're buying a U.S. Treasury. Yeah, basically, you're loaning the government money, and they promise to pay you interest, and at the end of a specific period of time, they promise to give you your money back. That's then if you want to do with a corporation, they're doing the same thing. Of course, you have a little more faith, hopefully, in the U.S. government giving your money back. You have a lot of faith in the bigger companies, IBMs and things. When you get to some of the smaller companies, maybe you don't have as much faith. That's why you demand a little higher interest rate. So each time that you're stepping out on the risk scale of something, you're going to demand a little higher interest rate.
You can lose money on corporate bonds. You can lose money on munis. You can lose money.
You can lose money on any bonds.
Even holding it to maturity.
Well, yeah, holding it to maturity, you're not going to lose money on a U.S. Treasury.
No, because they just let that money sit in your account.
And then
it's not going anywhere.
If the U.S. government defaults, none of the other money matters anyway. And so we're going to assume that we're dealing with bonds that don't default.
Yes.
So you're just loaning money. So you give them money, they pay you interest semi-annually, and then they give you all your principal back at a certain time in the future. There's no ability to, we're dealing with non-callable bonds, meaning the company or the issuer cannot call it back, and you can't force them to call it back.
Yeah.
You can't halfway through it say, well, I need my money now, so I want you to redeem this bond before it's due. And they're not going to. They're just going to let it roll. So it's just an IOU. It's a bond. It pays interest.
Well, it's like when you put money in your you deposit money in your savings account at your bank.
Yeah, but
they owe you that money.
They owe me the money, but the difference is the money in my savings account, I can go in there tomorrow and say, give me all my money, and they will give me to the dime plus accrued interest of all the money that's in the account. There will be no fluctuation of principal. With a bond, if the bond matures 8 years from now, let's say I bought a bond 2 years ago and it was paying me 2.5%, and that's probably about what the rate was on a 10-year bond at that time.
Yeah.
And I want it's a $10,000 bond, and I want my $10,000 back today. I can't go to whoever issued me that bond that has 8 more years to maturity and say, give me my $10,000. They're going to say, we have a contract. Our contract states that we're going to pay you 2.5% each year, and then after 10 years, you'll get your $10,000 back. We're not giving you your $10,000 back today. That's just the rules.
But you can.
But now I can go to
else.
the open market. And I can say, hey, John, I got this really good company bond here. I'll sell it to you for $10,000.
It's a great corporation.
It's not going to default. It could be a U.S. Treasury for that matter. Okay. It's not going to default. John, give me $10,000. I'll give you this bond. And you look at it and you say, why would I give you $10,000 for a bond that's only going to pay me 2.5% for the next 8 years?
When I can go buy a new one.
I could buy another one that's out there for 8 years that's paying me 5% or 4% or something higher. And I'm saying, well, because you weren't supposed to look at that. So you're not going to pay me $10,000 for an underperforming bond. So if I want to redeem that bond today, I can't redeem it. But if I want to sell it to somebody else, they're not going to pay me full face amount for it because they can't earn as much on it as they could on other things. Mm-hmm. So I'm going to have to discount it. The longer it is between now and when it matures. Now, if it only matures in a year from now, well, you're only giving up 2% or so in interest by doing it. So you might say, well, I'll give you 98 cents on the dollar for that.
But if it matures in 8 years
and you're losing 2.5%, 2% a year, you're going to say, yeah, I'm not going to give you 98 cents. I might give you 90 cents. There's a discount. There's a formula for this.
Yeah.
There's a true formula for this. But you're going to, if I want to sell it before it matures, I'm not getting all my money back. Now, it works the other way too. If interest rates are high and they go down, now instead of, let's say I bought a bond that's paying me 6% and it's got 8 years left to maturity, but new bonds are only paying 4%. And now you're coming to me and you're saying, hey, I'll give you $10,000 for that bond that's paying you 6%. And I'm saying, why the heck would I do that? Because what am I going to do with the $10,000 that you give me? I'm going to go back and buy another bond that's only paying me 4%?
Nope, not going to do it.
So if you want this bond,
you pay me a premium.
You pay me, buddy. Come on. Yeah. Pony up
the money.
A
little more than the $10,000
So there is fluctuation to the current value of the bond. Now,
and that's the risk, by the way. I'm sorry. That's the risk that you take with bonds, especially like with U.S. Treasuries. There's no risk of default. There's just a risk that if you need that money before the maturity date hits, then you may lose money.
So managing the maturities is very important to make sure that you don't lose any potential principal. And so when we're looking at bonds and we're looking at bonds, and this is one of the issues where there's a difference in buying individual bonds, which I can hold to maturity. If I bought a U.S. Treasury, 2 years ago that matures next year and it was paying, 2.5%, I know that next year when it matures, I'm going to get all my principal back, the full face amount. I don't know what I paid for, but I'm going to get the full face amount back. And so managing maturities is very important when we're dealing with bonds, understanding it. When you buy a bond fund, you have no control over those maturities. Bond funds do not hold their bonds until they mature. A bond fund has a specific agenda. It's a short-term fund, an intermediate-term fund, a long-term bond fund. And so if it's a long-term bond fund, as we progress through time and those bonds become shorter towards maturity in nature, they don't fit with the investment objective of that mutual fund. a mutual fund will end up selling them.
Maybe so we're talking about
time,
individual
maybe it's a bad
bonds.
time.
We're talking about individual
mutual
bonds
funds
here.
have a whole different game.
All right, so
now,
we're
talking about buying individual bonds, understanding the risk. And so a lot of people 2-3 years ago bought 3, 4, 5 year bonds with a 2, 3, 4% interest rate, knowing that at the time they bought it, that was an acceptable return, and they were willing to hold on to it for that 2, 3, 4 year maturity, whatever time. And if interest rates changed, that's what it was. They were buying it with a known rate of return. They were planning on holding it to maturity, and they did hold it to maturity. And then when the bond matured, they used it for cash flow and spent it.
Yeah. Now, you take that, so that's the bond side of it. Now, there's the fixed annuity side of it, which people understand, I think, a whole lot less. I'm sure there are people out there who said, to fixed annuity, that's an insurance product. What are you talking about as an alternative to a bond?
Well, and I've also heard that, never buy an annuity because the fees are just outrageous.
Well, let's talk about that, but explain very quickly how this sort of CD-style fixed annuity works.
Well, the fixed annuity, and the one that I'm talking about is, as you mentioned, CD-style, where the rate is guaranteed for a set number of years, and the surrender charge is equal to or less than that set number of years. So if I'm buying a 3-year fixed annuity, 3-year surrender charge, the rate is guaranteed for 3 years. I don't want to give the insurance company the ability to manipulate the rate away from my favor and give me something less than I had anticipated. So when we're looking at the fixed annuities, we look at a couple different rates. We look at the current rate, and then we look at yield, what we'll call yield to worst. What's the worst that the insurance company can do to me?
The YTW.
Because
I don't think I've heard that yet.
That's kind of what you expect to happen.
Yeah.
And unfortunately, I can walk into certain offices and see that sell annuities and say 8% rate, 10% rate on a fixed annuity.
I've seen that.
Yeah.
Maybe lately.
But that's only for 1 year. That may be a bonus rate. That may be just a teaser rate. But you have to lock into that annuity for 7, 8, 9, 10 years, maybe more sometimes. And you don't know what the rate will be the next year, the following year.
So we're not comparing.
So that's a different game.
We're not
and
comparing bonds to that.
Yeah. Unless the yield to worst is acceptable to me. Yield to worst. What's the worst the insurance company can do to me, which is what I expect them to do. If that's an acceptable rate, I'll deal with it. But I'm looking to use them more and understand them more, is fixed rate for 3 years, fixed rate for 4 years, 5 years, 6 years, 7 years. And when the rate has the ability to change, there is no cost, no surrender period, no market value adjustment, nothing that says I can't get 100% of my money plus all the interest I've earned and move and take it and do whatever I want with it.
Now, with a bond, oftentimes we said many people will take the interest that's paid to them and they will use that.
Yeah.
They would spend it. Now, a fixed annuity, a CD style that we're talking about.
Typically, you're going to let the interest reinvest. You can have it sent to you.
You're not necessarily taking cash flow.
Right. So I'm looking at, and that's another difference between the annuity and the bond. If I'm looking to have a bond for 3 years, 4 years, 5 years, and it's an individual bond and it's paying me interest, what do I do with that interest over the next 3, 4, 5 years while I'm waiting for the bond to mature? So I may not be able to reinvest it at the same rate of return that I was getting on the original bond.
Because interest rates
may have changed. Maybe I can get more. That's an unknown. With a fixed annuity, I'm reinvesting it into the rate of return that I was guaranteed at the beginning. So the reinvestment risk is not there.
So you have a kind of compounding?
Oh, it's compounding at that rate. And it's reinvesting so when the interest is paid, it becomes part of the principal, and that principal is earning what the rate was at the time, which can be either good or bad if interest rates go down or up. But I know exactly what I'm getting. And to what I said earlier that, never buy an annuity because fees are too high. With a typical fixed annuity that's locked in for like what I'm talking about, 3, 5, 7 years, whatever it is, there are no fees unless you get out early. So it's, again, looking at, if I'm buying a bond, I want to know that I can hold it to maturity. I won't have to sell it in an interim time frame. If I'm buying a fixed annuity, I want to know that I can hold it until the surrender period is over. I don't want to have a liquidity need between now and when that surrender period is over from that cash. So I'm kind of looking at them in the same way. What am I expecting to get from the annuity? what am I expecting to get from the bond that I'm buying for similar periods of time?
So if somebody wants to answer this question for themselves, which is, what do I do? I mean, do I look at fixed annuities? Are they a better alternative to bonds? Do you think that a fixed annuity back in 2022, if somebody had held those when bonds and stocks both went down as interest rates came up, do you think a fixed annuity would have been a better idea back then? And how do people determine which is potentially better for them?
Well, what we saw back in 2020, 21, 22, early 22, we were using fixed annuities in lieu of bonds for that 3, 4, 5 year time period. Were they paying a lot? No, nothing was paying a lot. Back when money markets were paying, the high yielding money markets, high yield online savings accounts were earning 0.5%.
Yeah.
We could probably get, 1.5% on a 3, 4 year, chassis, maybe, and a 3 year bond would be a little less than that. So we were using fixed annuities, and during again, this only goes, the interest rate dropping like it did only affects people that have to sell before the maturity date. So if you were managing your bonds right, you never had to sell before the maturity date.
So you were okay.
You're okay. It's only if you have to sell. Now with the fixed annuity, the problem is if you have to redeem before the maturity date or the surrender period, you got a surrender charge.
You got the same problem that you'd have with the bond.
So it's all about managing your liquidity, managing your rate of return. And as we get, the 6, 12-month, 18-month bonds, CDs, they're going to beat fixed annuities. But once you get to the 3, 4, 5 year time horizons, what I've seen are that the fixed annuities, locking it in for that period of time, tends to create a little bit better rate of return. Now, am I talking about the difference between a 4% rate of return and a 10%? No. I'm talking about the difference between like a 4% rate of return and a 5% rate of return.
Well, that's something, though, but especially over a 3 year period.
And assuming I'm dealing with very high quality insurance companies, so I'm getting a higher return for doing nothing different.
So what you're saying in a nutshell here is that if you've got a year, 18 months, maybe 2 years, you may be better off from an interest rate perspective for using treasuries and CDs where you can get a little bit better interest rate. But if you're going to go out farther than that, 3 years, 4 years, 5 years, you may be better off
with the fixed annuity. For the money I don't need for the first 3, 4, 5 years.
Well, and that's a very important point, Professor Plum, because you've got to, whether it's bonds or fixed annuities, you've got to look at this and say, I'm putting this away for that period of time.
Right. So
I have no intention of selling or surrendering.
Let's say my bucket number one, and we're getting into buckets, I know, requires $50,000 a year distribution. Well, the first $50,000 is going to be in money market, and then maybe 25, and then I'll do a $25,000 CD or T-bill, a $25,000 1 year, 6 month, 1 year, 18 month, 2 year, and I'll ladder them out. But once I get towards the 3 year mark, I may use a fixed annuity for the money for the $100,000 that I'm going to spend in year 4 and 5, and use a 5 year fixed annuity for the $100,000 I'm going to spend in year 6 and 7.
Because you're going to let that money sit.
I'm just going to let it sit for there anyway.
Nothing.
I might as well let it accumulate, compound at the higher rate that I could lock in from using the 6 month or 7 month. So it's just a matter of laddering them out. I'm looking for the best rate of return for the quality that I can get.
Even though bucket one rate of return is not as you said, the highest priority.
The highest priority of bucket number one
is safety and liquidity,
stability of principal, liquidity at the appropriate time, then rate of return. It's still a priority. It's just not the highest priority. You go out to bucket number 3, which is 15 plus years. Well, my priority is I want to get the best rate of return I can. Liquidity is not an issue because I know I don't need it for 15 years. Stability of principal is not an issue because I know it's got time to recover. So the characteristics of each of the buckets differ. But within bucket number 1, I need money that's liquid right away, but some of the money I don't need liquid for 4 or 5 years. I can lock it in on a bond or a fixed annuity for that period of time. So I'm looking for rate of return. Now, it depends on what kind of account I'm using as well. Because if I'm using an IRA where the taxes are deferred, all I'm looking for is what's my best rate of return. If I'm looking at personal money, now I'm looking at, are there differences in the taxability? Treasuries don't pay state income tax. So if I live in a high state income tax, I have to look at the differential between what a CD is paying and a fixed annuity is paying and what a treasury is paying and see if it's as much or less than the tax bracket that I'm going to pay at the state level.
You're talking about even for bucket one?
Yeah, for bucket number one. So if I'm using personal money for bucket number one, there'll be times where I'll use a treasury over a CD, even though the CD is paying a little bit more than the treasury, because I have to pay state income tax on that. And, the state that I live in, that may be 10% or more.
Depending on your income, yeah.
And depending upon the state you live in. So, if your state income tax is 1 or 2%, I'm not too worried. But if you live on, New York, California, one of the higher tax states, then we got to look at what is.
So you're saying to repeat this, you're saying that you've also got to look at the taxation
at times, yes.
At times, and say, well, even though a CD might pay me a little bit better, I can do better with I'll take a slightly lower interest rate on this treasury because I won't have to pay taxes.
Right. What I keep in my pocket after the taxes is more. And this is the debate between using municipals and or treasuries and or CDs, because municipals issued in the state of your residence, if you're in California or New York, you buy a California or a New York municipal bond, you don't pay any tax on it. And so we have to look at what is my net after tax return. And if I can get 4.5% on a CD for the next year, but I can only get 2.5% on a municipal for the next year, is that a good thing? Yeah, the 2.5% I get from a municipal, I don't pay any taxes on it. Is that better than earning 4.5% and paying some taxes
on it?
What's your tax bracket? What's your state tax bracket? What is your federal income tax? You got to bring the federal back into that one now.
So you do all of this.
We have to look at that
when you're putting your bucket strategy together.
We were working with a larger client, and we were working with one of the money managers, and we were looking at the yield, the yield to maturity on a 5-year treasury was X. Well, what about a municipal? Well, the yield to maturity on a 5-year municipal was Y. Given the same duration, given the same. And obviously, we're looking at the counties that we don't think are going to go bankrupt.
Yeah, of course.
Try to take that risk. But what is that equivalent yield? Now, a lot of times they'll tell you what the tax equivalent yield is, but they assume that you're in the 37% bracket and you've got a high state income tax bracket. So you have to understand when you see that tax equivalent yield, are you in the same parameters that they're using to tell you? Are they
assuming worst case scenario for that?
They're assuming high. They're assuming you're Bill Gates.
Okay. Sure. Right.
Only. Yeah.
Bill Gates buying treasuries.
He could.
I guess. I don't know.
What else is he going to do with it?
So on a bucket strategy, this is okay. The question, as we said, are fixed annuities a better alternative to bonds? Now, what you said,
they have been, yes, for that appropriate time horizon.
As long as you look at all of this other stuff that you talked about. Uh-huh. So I want to say, again, that if you're looking at it for a bucket one, if you're looking at fixed annuities versus bonds, you may want to use bonds for a portion of it, maybe the shorter terms, and at some point, maybe the 3-year money, 4-year, 5-year money.
Typically, you're not going to get annuities shorter than 3 years. And so that's about, if you need to have cash flow coming from your portfolio in the next 2 to 3 years, you're not going to cover it with an annuity. But once you get past the 3-year mark.
Oh, they don't have a 1-year.
Well, no, because there are expenses, and the insurance company has to be able to invest the money and make enough money to make it worth their while to pay you the interest rate they're paying you.
Yeah.
That doesn't always mean that 100 years ago, not 100 years, 30 some years ago when we were playing this, we were able to get very short-term annuities that had very good rates. But that was a different environment. That was in the mid to late 90s.
That was a different era. So there's a lot of criticism, Professor Plum, and I was just seeing it again today from generally a couple of the really big investment firms who say don't ever consider an annuity.
Right.
You can always do better. But what you're saying is that may not necessarily be the case.
Well, they're saying you can always do better in the stock market. No, that's not true. You didn't do better in 2022.
You did not. And I don't know. They've never answered that question.
You didn't do better in 2000 to 2009. You didn't do better in 2006 to 2009. You didn't do better. I mean, there's lots of periods of time on the shorter end of things. One of those I mentioned was even 10 years. But when we're talking about shorter time horizons, the stock market is not a very good alternative because there's a decent risk to not getting back the money that you invested. There's also a decent return potential. Mm-hmm. But if I need $1 to spend $1, I don't want it to be 90 cents. I want it to be $1. I want it to be $1.
What reason would somebody have not to? If they're trying to just decide bonds, let's call it, say, treasuries, versus a CD style fixed annuity, what reasons would somebody have to not choose bonds or to not choose annuity?
You're looking at the quality of the insurance company to make sure that they're still going to be here 3, 4, 5 years from now. You're looking at the rate of return.
That's it.
And the surrender charge. How long does that you can get a 3-year rate guarantee, but it's got a 10-year surrender charge on it. So you have to basically accept whatever they give you at the end of 3 years. So
which may be nothing.
Right. And there's also some little things that I have pet peeves about. Some of them have, at the end of 3 years, you've got 30 days to decide what to do. Some are 30 days before the surrender, at the end of the 3 years. Some are 30 days after the 3 years is up to decide what to do with that money. I don't like that. I don't like being forced to make a decision that quick sometimes. So I like, once the 3 years up, the surrender charge is gone and it doesn't come back.
So it sounds like
once the period of time, I should say, is gone, the surrender charge does not come back.
So it sounds to me like if you're trying to make this decision, it's generally going to be, in many cases, if not most, some kind of blend of bonds and fixed annuities.
We use fixed annuities as an alternative bonds that if they have a better rate of return for the given period of time that we're using it. If we're laddering bonds, if I'm looking at a 3-year, what's the best 3-year bond I can get? What's the best 3-year fixed annuity where the surrender charge goes away at 3 years? 5-year. What's the best we can do? And that's if I can get a better bond, we'll use a bond. If I can get a better fixed annuity, I'll get a fixed annuity. Now there is a difference though. Fixed annuities don't work as well in smaller dollar amounts because they do.
Meaning what?
They do band it, meaning you get a better rate the larger the deposit. So there may be a break at 50,000, or there may be a break at 100,000.
You mean if you put in?
So if you put in less than 100,000, you get a quarter point less than what you would get if you put in 100,000 or more. So we have to you have to understand how much you're dealing with.
Well. Yeah. This sounds awfully complicated to me.
I was talking about municipals a few minutes ago, and I just wanted to bring up one thing. Municipals are the interest that you receive is tax free. And if it's issued in the state that you live in, it's state tax free too if you have state income tax. But remember we talked about if the bond rates are different and I have to pay a premium or if I'm paying a discount. So maybe I can buy a 5-year municipal right now that has a 1% coupon rate and 1% interest rate. Why would I buy that? Because I'm buying it for 85 cents on the dollar, and it's going to grow from 85 cents to 100 cents on the dollar in 5 years. So it's going to make a lot of money and then mature. So I paid $85,000 for this $100,000 bond and matures for $100,000.
So you got $15,000 at the very end there.
Yeah. But I also got 1% of interest every year.
Yeah.
So I made, that's
you didn't make much along the way.
That's a really good rate of return on that appreciation.
Yeah.
And it's a municipal, but it's not all tax free. Only the interest that I received.
That $15,000 in your example.
$15,000 of gain is capital gain. I paid 85. They gave me 100 5 years later. That's a capital gain. So I'm paying tax on part of the return of that municipal. So understand the tax difference in these things.
I was starting to say how complicated this all seems, but you guys do this kind of as a matter of, do you have to, is this all this, are you doing math all day? What are you doing when you're putting these together?
I'm much better at math than language.
As we've found out, yes.
Anybody who's talked to me knows that.
Anybody who's talked to you knows that you can explain the thing for the next hour and a half, and we try to keep this as simple as possible.
And I can try to do mental math in my head and come pretty close to the right answer most of the time.
So for people who think you're putting, you just put cash away in bucket number 1 and don't think about it, you have 2 years of cash. It really, you try to do the best you can from an interest rate perspective after you've covered the
safety and
non-volatility and the liquidity issue.
Right. Yeah. So, it's like I don't understand people that keep $100,000 in their savings account at their bank next to their checking account that's earning 0.05% or point.
Yeah, sure.
It's like you can move that money to a FDIC insured savings account that's paying you 4 or 5%. You've got the same security. You've got the same FDIC insurance. You're doing the same thing with it. It's money you're not expecting to touch. It's not your checking account where it goes up and down every day and you need to be able to write a check on it or debit or however you take money out of your account. It's money you have sitting on the side that you may or may not need. And I was talking to somebody yesterday. They have $100,000 in their account, savings account, and it's earning $50 a year in interest. Why not move it to an online or a high yield savings account with FDIC insurance linked to your checking account? You can have it back the next day and earn $4,000 in interest, $5,000 in interest.
Yeah.
For doing what different?
Well, nothing.
Basically nothing different, but you're earning money.
You can't go visit it in a, you can't go into the vault and visit
If I had $100,000 in my neighborhood bank, I don't care which bank it is, regional or otherwise, and I wanted to go in there and to withdraw $100,000 in cash right now.
Yeah.
I doubt they would do that. They would probably have to order that money from somewhere because I don't think they carry that much reserve in the bank.
No, but even if you wanted it transferred, to your checking account, I mean, on an online bank, generally it can take a couple of days depending on...
The one I use takes a day.
Okay. A business day.
Yeah, one business day.
Right. So
I have yet to run into an issue where I need $10,000 this very minute.
Where you run in all out of breath?
I got to have 10 grand right now.
And you keep looking over your shoulder?
I would once, though, like to have one of those bundles that's banded.
Oh, yeah.
That's just banded so tight you can't move a dollar in or out of it.
Yeah.
And I just want to have one of those. I've never had one of those in my hands.
Really? After all these years?
I would have thought so. Never dealt with that large a sum of cash.
That would be scary to me.
Having a $10,000 bundle?
Yes. Just if it's mine, somebody's going to run by and say yoink. And if it's somebody else's, I'm going to accidentally lose it. But
you can run and you can chase them. I'm slow.
Well, I suppose that's true. All right. Well, this complicated stuff is made easy. I shouldn't say it's made easy, but the folks here at Lucia Capital Group, they've done this for many, many years, and they can do it for you. I would suggest you, if you have not done so, many of you have, but if you have not done so, give them a call at Lucia Capital Group, 800-644-1150. They're there to figure all this stuff out for you. Yes, it's complicated, but you want it done right. 800-644-1150. They'll talk to you about this and get your bucket strategy all squared away because, yes, it is all about that. I don't want to have to make some of these decisions, even one that seems as simple as, is a fixed annuity potentially a better alternative to bonds? I'd rather have somebody else who's done it take care of it for me. 800-644-1150. Subscribe to this podcast, would you, please? You can do so at Apple Podcasts. You can go to Spotify and download this every episode to your device and listen, as many people do on a regular basis. You can also, I said subscribe to this. What else can you do? I've forgotten. There was something else I was going to tell people to do, and I've completely forgotten.
Go to the website? No.
That's a good one. That's right. Go to the website. That's what I should have said. I knew there was something I left out. LuciaCap.com, LuciaCap.com, and get a lot of this information. Some of the stuff, when you go back to the archives, we do talk, because interest rates were so low.
Way back when.
Yeah, so maybe some of the newer stuff, but just check the date.
And hey, if you're in Southern California, come by the office, say hi.
You can play golf here. We got a golf simulator here.
For people that play golf, I don't.
Well, I mean, I don't hit too many golf balls myself anymore.
And I've been looking at the weather around town or around the U.S.
At currently, yes.
San Diego's a pretty nice place to be right now.
It's not bad. That's right. Come on down and check us out. Professor Plum, thank you so much. As always,
very welcome.
Always appreciate this, and we will be back next week with more. We thank you for listening. Don't forget to subscribe. And for Professor Plum, a certified financial planner, CFP professional, I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. This material should not be considered a solicitation of an offer to buy or sell any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not not guaranteed and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Municipal bond interest may be subject to the alternative minimum tax. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.